All right, so let's talk about making cash money with this 1DT trade. And I really mean that term, cash money, because we have been making money consistently with these 1DT trades. Even when we had to adjust it, we were able to get the monies back.
Subscribe to our channel. Happy trading.
And so I want you to understand the process, the steps that we take for this 1DT trade, and then you can decide how you will start learning this process. It's not an easy trade, right? It's not a 0DT trade, which is the hardest trade in options in my opinion, because it has the most gamma risk, the most directional change of risk that happens, because gamma measures the rate of change of your directional risk. The 1DTE is the next most risky trade, but it's about 50% less risky than the 0DTE trade. It's not linear. It's not linear. So you will see the ability to be able to adjust the 1DT trade more. You'll be able to deal with certain type of moves better with the 1DT trade. But you do have overnight risk when you're doing a 1DT trade. You do not have that overnight risk with the 0DT trade. That makes it attractive and you can make the most. But as long as we've been trading this, we have never woken up the next day and had the the 1DT trade in the money. One time it was close, but never to this point. But that doesn't mean it won't happen one day. That's going to happen eventually. You do not want to be fooled by randomness or probabilities. It's going to happen. Just because it hasn't happened in the past for us doesn't mean it won't happen. It's most likely, not most likely, it will happen. So you want to be prepared for that. But if you wake up the next morning and your trade is in the money, even if it's fully in the money, it's still not going to be a max loss, and you can decide at that point to roll it out. And if you had to roll it out a few days or more than 30 days, you can do that. And you just slowly figure out how to get your monies back. And we talk about that in other lessons. But for today, let's just talk about the process of what you want to consider to initiate the trade. And then if a problem occurs, what you want to do next. So first of all, we're going to do this in the SPX. And then we're going to find this option chain. I'm going to hit clear here. And we're going to go to this 1DTE. And we're going to look at the VIX, this VIX cash volatility index. And we're going to do what is called the rule of 16. We're going to take the VIX number, which is currently 1712, and we're going to divide it by 16. So you take the 1712 and divide it by 16. That's going to give you a percentage move, what is expected percentage-wise, plus or minus. This is the 1.07% is expected to be plus or minus tomorrow. It can either go up this amount or go down this amount. This is what is expected. And most of the time, volatility is overstated, meaning this is too high. This expected move is too much. But it does not mean it can't go more to the upside plus that, or below that to the downside. It can go more than this. Okay, but this is what is expect. This is the expected move, though. Right? And if we break it down more, and go over here to this expected move on the TastyTrade platform, they're saying the expected kind of range at expiration when this expires tomorrow is plus or minus 23, basically. Okay, it's going to fall within this range here, this ruler. TastyTrade does a really good job of kind of giving you these visuals. So this is where it's supposed to expire at. Doesn't mean it can't go up here, go down this way. This is going down on an option chain, or go up. This is going up on an option chain. Be way over here. But at expiration, 68% of the time, it's going to expire within this move here, within that ruler there. It's going to expire in there. So we want to take these factors into place. We know it's about a 1% move up or down. The VIX is saying we know the expected move is 23. Well, we want to try to be at least 2 times that expected move, or 1.5 times that expected move. But I also like to look at the straddle price, and that's just buying the straddle price, where it's at the money. You just buy the straddle. Buying the straddle just means you're buying the call and buying the put at the money. At the money is where the stock is currently trading at. So this is telling us about 25. So if we double that, that's 50 points. 50 points. So I like to use the straddle price more than the expected move. Even though TastyTrade, their formula is better. It's usually going to fall within what their expected move is. 68% of the time is super, super close to this number, right? It's more, this straddle number is usually more overstated. It's more overstated. So that's why we're looking at that at this point. So 25 and 25 is 50. So we're going to try to see if we can be 50 points away. We're going to go and look at the 5 delta first. And if we look at this 5 delta here, that's the 42.50. And let's say we're going to do a 20-point wide spread. Okay? And then if we go to the put side and we look at the 5 delta and let's do a 20-point wide spread, that would take us to here. So that's giving us $70. It's not great. It's not bad. Ideally, we want to receive $100. But $70 to $75, that's fine if you want to be as vigilant as you can possibly be. But let's look at this a little bit and let's see if we can do a little bit, we can do a little better on here. Okay, let's see if we can do a little better. All right, so 50 points from where it's currently trading at. Let's see if where that lands for where we're at. So you got the 41.93 plus 50. That's going to take us to 42.43. Well, we're at the 42.50 on the call side. So this is more than 2 times the expected move. On the put side, if we take the 41.92 minus 50, that's going to take us to 41.42. So we're also more than 2 times the expected move on this put side. So now we can decide which side we want to move up if we want to get more than this $75, or we can say this is a perfect type of trade at this point. It's about 20 minutes left in the market before it closes. We're 2 times the expected move on both sides. It's giving us $75. It's not giving us a lot, but it's giving us a decent amount. This trade to me is great. If we can get filled at this, awesome. If not, we're going to adjust one of the sides. So this is what we're going to execute this at this point. I want to see if we can get the 75. I doubt it. We're going to put it in. We're going to count to about, we're going to give it about a minute. And then if we can't get the 75, then we're going to adjust the trade a little bit. I would adjust the call side. In my opinion, I believe the market has already been overdone to the upside some. So I'd rather have the risk to the call side than the put side. So we're going to adjust that. We're going to give it another 5 seconds. 1, 2, 3, 4, 5. We're not going to get filled. So what we're going to do is cancel that, and we're going to adjust the call side and see if we can get filled for the amount. We're still going to be we're still going to be 2 times the expected move on that call side. So now that's 85, right? So we're going to send that, and we're going to not get filled. So we're going to drop it immediately to 80 so we can get filled. So, and we should be able to get filled at 80. I'm going to count 1, 2, 3, 4, 5. We didn't get it. Just for my patience, I do that. So we should have got filled at the 80. We're going to give it a little second, see if they'll fill us at that 80 spot. There we go, right? So we just got filled at that 80 number, and we are 2 times the expected move away on the call side and 2 times the expected move on the put side. We left out a step of what we want to look at. We normally want to look at the economic news that's coming out tomorrow. We looked at that this morning, so I kind of disregarded it. But we have some service PMI for May coming out. And we have some new home sales. The service PMI can be it can be market moving. I don't think it's going to be. So this is why we're able to. That's why we put on this trade. So let me just explain the adjusting that you want to do on this. So you want to learn how to adjust these. You want to learn how to adjust the 0 DT trades. You want to learn how to adjust the 1 DT trades if you're doing this. And even if you're doing stuff, any short-term stuff that we consider, 0 to 14 days to expiration, we consider that short-term trades, or technically anything under 30 we consider short-term trades. But really that 2-week window, right, 0 to 14 days, that you want to know how to adjust because you're going to have to. So in this case, what we would do is the simplest way is that you're going to roll this out if it goes into the red zone. Right? So the red zone for us, you guys know, starts at the 31 delta. We put it on the call side right now. This is a 6 delta. So the red zone would also be on the put side at the 31 delta. That's the start. This is a 5 delta. So it would have to go down or up a really significant amount before it gets to that red zone. And then at that point, you can roll that out. Yeah, you have the options to be able to do rollaways as well, but in this case we're going to roll this out tomorrow if we have to, and we're going to roll it out to 1 day, 2 days, 7 days. It all depends on how bad it is. We can even roll it out to 30 days as we indicated earlier, but that's our game plan. We're going to let it play out, and if it goes in the red zone, we will adjust it and then see if we can win the next day or in the near future. Right? So that's the play there.